Welcome to Coin Toss, the show where we respectfully and often vehemently debate the big questions within our modern, financialized, and increasingly tokenized world. I'm your moderator and Coindesk editor, Adam B. Levine, and this is episode 1 of Coin Toss, which you'll find live on Coindesk.tv every Wednesday at 10:30 a.m. Eastern, 7:30 a.m. Pacific. Our debate today zooms in on the controversy unleashed last month when the traditional financial world was beset, or some might even say attacked, by a veritable horde of retail traders. According to many, the GameStop Wall Street bet saga highlighted systemic weakness or even unfairness in traditional markets. This time, we'll talk about the problem, the hearings, and the role technology may play in making our markets just work better. Given the rise of social media and innovation in the fintech space, is the current system in need of more reform and regulation? Sitting in on today's discussion, we're honored to be joined by Harvey Pitt, former chairman of the Securities and Exchange Commission. Hello, Chairman.
Good to be with you.
And Donna Rydell, a businesswoman and professor of blockchain digital assets at the Fordham Law School. Donna previously served as the managing director of the World Economic Forum and chair of the COMEX Commodities Exchange. Donna, thank you for being here.
Pleasure, and very happy to be joined and honored to be joining Harvey Pitt and you, Adam.
Yeah, indeed, Professor. Thank you very much. So with all that said, I'd like to just jump right into it. Professor, in just about 24 hours, we'll see congressional hearings kick off addressing last month's market turmoil. While there seems to be broad agreement that there was inappropriate behavior, let's just call it that, there's a lot of disagreement about which parties are at fault. Some blame a market structure that bans naked short selling, but which does not appear able to actually stop it. Others blame retail traders for collectively publicly investing in a way that they hoped would hurt hedge funds. Still others say that Robinhood and other retail trading apps like it walked away from their critically neutral role by letting users sell but not buy positions in stocks being discussed in the Wall Street Bets Reddit community. And deeper still, some criticism has fallen on the DTCC, a shadowy company that is the actual legal owner of nearly all equities changing hands on public markets today. And finally, the hedge funds. Nearly everybody seems upset with the hedge funds. So, Professor, if you could start us off with your view. Last month, as all this came to a head, what went right, what went wrong, and who are the bad guys in this convoluted drama, if any?
Well, first of all, I'd say all of the above to the things that you mentioned, since every one of the entities or the players that you talked about had some input into the overall controversies that happened let's just call it the GameStop incident. But what I do think happened for the most part was that people were surprised at the market structure. They were surprised to learn about clearing and settlement and the DTCC and the terms and conditions of the documents that they signed to become a trader on Robinhood. So this all came together in a way to expose elements of the system that are there. And the fact that there was trading and there was shorts and all of these components which exist all the time all came together, collided together in a way that caused enormous controversy. And out of controversy, we can create positive. So I think that the hearings and the subsequent investigations and conversations that the SEC, which I'm sure Chairman Pitt will speak to, will produce positive results for the future.
Chairman Pitt, let's get your take on this. What does Donna have right there? What else do you think is worth mentioning here? And kind of what's your take on events that happened last month?
Well, I think the events that happened last month are like the confluence of all sorts of difficulties hitting at exactly one point. You have unsophisticated traders who are self-directing their own trades, many of whom are just not familiar with the way our markets operate. In addition, you've got a burgeoning marketplace where the number of shares traded was out of control, and you have short selling where the amount of shorts exceeded the amount of stock actually issued by GameStop. So this stock was shorted well over 100%. Most people would say that's impossible, but in fact, that's what occurred. And so at the same time that you have investors being urged to invest more, you've got increased transactional costs. And so firms like Robinhood have had to put up more security as required by DTCC. And that amounted not to millions, but billions of dollars. And at some point, Robinhood had to shut down the trading so that it could continue to exist and so it could post the security that was required. One of the interesting things about tomorrow's hearings is that it occurs before we really know everything that took place. Right now, we're reading a lot of things, we're hearing a lot of things, people have their thoughts and ideas, many of which may be right, but many of which may be wrong. And so the difficulty you have is it's impossible to solve a problem unless you actually know what the problem is. And that's why the SEC has undertaken a thorough review. Hopefully they will finish it up quickly. And once we have that review, then we can determine who violated the law, if anyone. We can determine how the market system failed various components of the marketplace. And we can have a rational judgment about whether we need additional regulations.
Yeah, I just wanted to jump in and say, I spend a lot of time not only in teaching, but in the community in and around crypto. And there was enormous amount of conversation about the GameStop and everything that was happening in the marketplace. And again, people there were surprised about the centralization because to the crypto community tries to be decentralized. The transactions are settled almost immediately. And so a number of the things that happened in the GameStop scenarios, they were kind of relieved that they're not in that situation because of the decentralization of the overall Bitcoin crypto markets. And so I think there's a lot to be learned and on the kind of unmasking to the general public everything that went on, including the interlocking relationships between Citadel and Robinhood, were very interesting to all.
So decentralization has a lot of advantages to it, but one of the downsides that it has to it, one of the advantages that it has to it is that it's very robust against sort of shocks coming from various directions. The so-called anti-fragile systems, where the more they get hit but survive, the stronger they get. Chairman, I would put this question to you. Did the Wall Street Bets traders find a weakness within the system that they were then successful in pressing on? Again, like is the kind of way the modern financial system or modern stock trading systems work inherently, does it have these weaknesses that can be pressed? And are you concerned about something like that in the future?
I'm not sure whether it's a weakness or not, but we have seen the interaction now between social media, free speech, and then self-directed trading by the masses. And all of that is like a perfect storm. It is creating movement that no one had seen previously. Part of the difficulty is if all you're seeing are people expressing their opinions about trading, and let's assume hypothetically that's the case, the First Amendment is going to make it virtually impossible to shut that kind of thing down. And indeed, we should all be reluctant to see the government tell people they can't make postings about their opinions. On the other hand, if the people who were making the postings were people who had an ulterior motivation to artificially influence the price of the stock, then there is a likelihood that what occurred was manipulation. And if manipulation occurred, there are already laws on the books, and there is ample authority for the SEC and others to go after this kind of activity. That's why the real issue is who said what and why, and getting behind all of that is what will be critical to making the proper determinations about what comes next.
Yeah, and to follow on that, I mean, one of the key things that ulterior motives, that it wasn't transparent. And so people need to know that. And that's what ultimately a lot of the SEC investigation will look at. And it is a little premature, but that's politics to have hearings tomorrow without knowing the full extent of what's going on and what happened. But, you know, what can we do? That's the way you grandstand.
Yeah. Well, so I think, following up on both of those points, which I think are very well made, I think there's a perception here that there's an unequal application of the law between different types of market participants. And I think that there's been a lot of, concern or even anger within sort of parts of the retail trading community because again, what Wall Street Bets did in public, in a public forum, where again, there are potential concerns for fraud and people having motives that aren't disclosed. On the other hand, you've got the phenomenon that's been true for a very long time of, hedge fund idea dinners or private networks where hedge funds, where basically big money folks compare notes and figure out what they're going to go after sometimes. And it seems like the differences between these two things is that one of these things happens in public and the other one happens in private. So again, like how much of an issue do you think the perception, at least, if not the reality of unequal application of law comes into play here around some of the high emotions that we've seen around this issue?
Look, I'm not defending hedge funds, and especially in 2020, when so many of them, during a pandemic, during unquestionably difficult times for the global economy, for people in general, made new amounts of headlines in the money that they took home. So I do think there is asymmetry in the application of the law. And a lot of it comes with power, and power corrupts. So I do think that that's not a new problem, but it's one that you have to determine whether or not a law was broken, not in fact that people had dinner together and chatted about the way in which they foresee the trends, et cetera. If you're talking specifics, and they then, as Chairman Pitt would well establish, if they're talking specifics and they decide that specifically they're going to do X, Y, and Z, and then don't disclose that they're a group, that's a problem. But it's difficult to be able to really pinpoint those things, and I do think one should be able to look more deeply into it.
Thank you for that, Professor. Yep, go ahead, Chairman.
Oh, I'm sorry. I just to add to this, one of the concerns that I have is that you've got very unsophisticated people who've now been given a very powerful tool, self-directed trading. No one could object in general terms to the fact that people can go online, can trade whatever they want, and can determine their own course of action. The problem is that many of those people are highly unsophisticated. And when they go online in that manner, there are limited obligations and duties owed to them by brokers in securities, because under those circumstances, the brokers are functioning as mere conduits for trading. On the other hand, one of the first lessons I learned growing up in Brooklyn is there is no such thing as a free lunch. And yet many of these unsophisticated investors thought there was a free lunch. They were told there are no commissions and that they can do whatever they want in terms of self-directed trading. And they didn't realize that somebody had to be paying for the transactions that were engaged in. So when you have that kind of activity and then the rest of the system kicks in, for example, as I mentioned, with DTCC requiring Robinhood to put up billions of dollars, these investors suddenly get caught by surprise and are unaware that suddenly their trading is halted. they think it's because Robinhood was trying to help the short sellers. In point of fact, it was because Robinhood was trying to survive. And the difficulty you have is that when you have unsophisticated investors who don't understand the system and the nuances, that will invariably lead to problems. And we saw that with the run up of stock that was nowhere worth on the fundamentals the values it reached. And yet at the same time, people thought this was the way to make money and that there was no tomorrow, in effect, no consequences, and that the price would just keep going up. Anyone who understands markets knows that whatever goes up has to be able to go down.
Yeah, I think we've seen too much in the past of laws and regulations that try and limit what retail investors can do. I mean, we know that the whole system of the SEC was put in place post 1929, and the emphasis is on the retail trader. We've recently had some relaxation of by the SEC of rules around accredited investors so that more individuals would be able to invest in startups. We see some good crowdfunding. We have some good rules around that. So I would not like this to be a way in which we put more barriers for individuals to invest, whether it be in the stock market or in startups, as a result of this. I think if the regulated entities, of which Robinhood is regulated, if they have some ways in which they want to improve their disclosures, improve knowledge about the market systems, that's fine. But I don't think we should take away the free choice from the individual investors.
Well, thank you, Professor. Thank you, Chairman. Stay tuned for after the break, when our discussion turns to the foundations of our modern system and the role that some believe blockchains can play in improving things. We'll be right back.
I'd like to cover in history, 20, 30 years ago, would have been the internet. It would have been the whole social media boom. Now this is our turn. This is this generation's turn to cover the future of money, Web 3.0.
I can't think of a more important story than this one to be telling. We're talking about the transformation of money itself. So to tell this story, right, the most significant story in finance that's around, we need new mediums, new ways to reach people, new ways to reach this global audience, the human beings for whom this is going to be most important. So this is why we're really excited to launch CoinDesk TV, because it's another way to reach people. It's another way to communicate. It brings to life the stories that sometimes can be difficult to access.
We're going to see a huge paradigm shift. We're going to see how it lives digitally, natively in the internet. We're going to see that transformation shift.
This is a huge opportunity to tell a very, very important story that reaches a wide audience that has the potential to change everything.
We're building a financial system across the world with Bitcoin, several other cryptocurrencies, digital currencies made by central banks, and that is going to be epic.
This is a huge opportunity to do this differently, and CoinDesk TV is going to sit right in the middle of all of that.
Welcome back to Coin Toss. We've been talking about the GameStop short squeeze, and in a moment, we'll move our conversation just a little bit into the future. But first, let's talk about the way things work today under the hood. According to Wikipedia, the Depository Trust and Clearing Corporation, also known as the DTCC, is an American post-trade financial services company providing clearing and settlement services to financial markets. It performs the service of exchange of securities on behalf of buyers and sellers and functions as a central securities depository by providing central custody of securities. Chairman, can you please untangle that for us? What problem is the DTCC solving, and do we need it in markets today?
Well, you definitely need a centralized clearing body, and the whole purpose of an entity like DTCC is to permit shares to be traded freely, so that if you're buying stock and I'm selling stock, there are clear indications of who owns the securities. Back in the 60s, when I first got into this industry, we saw enormous problems with failures to clear stocks and failure to deliver stocks and the like. And DTCC was established to try and eliminate that. Today, stock certificates really are a thing of the past because most securities transactions are reflected on book entries. There aren't shares of stock that are passing from one person to another. There are book entries which show that I sold and you, Adam, purchased a set number of shares. And at the end of the day, DTCC is supposed to come out with a complete net zero, change in the location and the amount of stock that's available and out there.
So I would just take exception with one thing, which is it depends in your statement. We have a clear indication of who owns the security. And I would say that the you in the sentence is not the same you that I think needs to be able to indicate owns the security. I want to know that I own it and not Schwab or Fidelity or wherever else my account is. It has it in nominee, and that's about six degrees higher than me in some cloud. So I do think that that is the crux of the DTC problem at this moment in a more technologically driven society in which we can do real-time settlement and to bring something I know that Adam will bring in later on the blockchain. Not easy to do. If it was easy to do, they would have done it already. I think that they have, because I know they come to my class, they have it in the works. Perhaps this will press it further, and it would give me the ability that if I wanted to, in a little bit more time, I would be able to have my stock in my wallet if I so chose.
There are.
Right. I think, sorry, go ahead, Chairman.
I'm sorry. First of all, you come head on to a collision between an individual's right to privacy and the way transactions are structured. So, for example, if somebody could quickly and easily determine all of the shares of stock I own in various companies and the like, that is viewed by some as an invasion of my privacy. I don't want people knowing my net worth exactly. On the other hand, the existence of having stocks held in street name, which is what Donna was referring to, has been a practice that has existed since the beginning of organized stock trading. There are real problems. I also would have to say I take exception to the notion that we can have settlements on a current basis. We have the ability to do that. We need to do that, but we aren't doing that. There is not a T+0 settlement basis right now. And until we get to the point where all transactions are cleared and settled immediately on the exact same day, we will always have problems in the system.
No, so we agree that settlement, same day settlement, is the goal. And furthermore, in response to the identity issue, people have wallets. The Fed is currently working on a digital dollar. You will have a wallet. Your wallet won't necessarily have your name. It will have an identity, and that identity can be in the same way that crypto assets are done. It's pseudonymous, not anonymous, and it will be able to be in compliance with privacy, not only in this country but in other countries as well, where they have GDPR, et cetera. So I think that we need to move in that direction. If GameStop could be an accelerant, that would be fantastic. And that would be a good outcome to push the technology in a way that decentralizes some of these actors and makes everybody more in charge of their own assets and destiny.
Okay, I hate to interrupt this, but I want to take us a little bit further afield here. So, we've been talking about the DTCC, which really, it feels like to me, as someone who's come from the world of blockchain, plays the role that a blockchain would play if the system were being created today. It seeks to create a single common source of truth that then allows for participants within the system to have a reference point to which they then use, and it's supposed to play this neutral role. Professor, if you don't mind, can you explain to us what a security token is and talk about any sort of applicability you see here? And then we'll go to the chairman for a response.
So a security token would be a security, let's just say in this instance, a share that's represented by a token on a blockchain. And it functions in the way that a share does, except for it is coded with a smart contract. So the dividends and all other things could be passed through that. There is an interest in wanting to go in that way. There have been a number of hurdles with the SEC and also institutional investors. And the DTC does not act like a blockchain because there have been a number of different cases, not only this one where there was more than 140% of the stock that was between the shorts and otherwise. There's a good case I teach. One is Dole, in which, again, there was not able to see how many shares there were, et cetera. And also Dell, when it was going private, had the problem of who are our shareholders of record at any time. And so one would think that the DTCC can do that, but in fact, it is not a blockchain. It is a settling up system where at the end of the day, in T+2 days, they settle everything in some way. Security tokens would serve in a different way to be able to record who has any specific share at any time in a way that the DTC would not.
Chairman, what are kind of the arguments against using a different structure than the one that we have today? First off, do you think that, you said that the DTCC is necessary in today's modern market. Do you think that a blockchain could serve the same function in a future system? And if you don't, I'd love to hear the arguments against it.
Well, first let me say, I don't think DTCC, the entity, is essential. I think the functions that are being performed are essential, and there are many ways to provide it. I think there are some significant difficulties in having one entity that has this kind of control over the system and is anything but transparent as to what its rules are and how it functions. Second, I guess I would say that blockchain may well be the way in the future to take care of this. Part of the difficulty is that the system is sort of like me with my remote controls at home. I don't like having to give up a remote control I already know how to use and getting a new one that I'm going to have to learn all over again, the nuances of which I may not understand, and that can create all sorts of problems. Usually I have one of my children explain this to me because they understand these things far better than I will ever understand them. But I don't think that until issues like security, who controls the system, who has the key to unlock security, and things of that nature are laid out satisfactorily to the regulators, I think people are going to approach some of this with a certain degree of circumspection. I think the SEC is on the verge of having a new chairman take over who is far more knowledgeable about how markets operate than we've seen in decades and decades. And I think that he is somebody, Gary Gensler, who understands both the utility of blockchain and a lot of these issues. So I believe that there can be and necessarily will be a movement, provided there is a satisfaction of the kinds of institutional concerns that people at the SEC are still raising and that are impeding these developments.
And the good thing about Gensler as well is he comes from having been chair of the CFTC, where those markets have next day settlement. So he already is very familiar with the need for faster settlement and how that has integrity in the market, et cetera. So moving by one day, which I don't think I'm not suggesting we go to same day, but he already knows the value of that. So we don't have to convince him. I think that his knowledge of both of the markets and having been hopefully chair of both commissions will really serve all of us well.
Well, Chairman Pitt, Professor Riddell, it's been an honor having you on our first episode, and we hope you come back very soon.
Thank you so much.
We have for this first. Yeah.
Good luck. Good luck on your future episode.
Thank you. That's all the time we have for this episode of Coin Toss. Tune in every Wednesday at 7:30 a.m. Pacific, 10:30 a.m. Eastern for new debates with reasonable people saying sometimes unreasonable things about our modern world. I'm Adam B. Levine, a CoinDesk editor, and until next time, keep the conversation going.